There's a saying in Germany that I always like to use there is Bismarck, who was a famous chancellor in Germany. He always used to say that there's two things that people should never know. What goes in a sausage and how laws are made. And it's a little similar with blockchains, because the reality is that we don't really have the principle of decentralization is currently not fully applied in any blockchain project. Mm-hmm. Like it's a myth, right? Like, I mean, we can talk about Bitcoin, the most maybe decentralized one, and there's 3 mining pools in theory who kind of hold all the power. Like there's just, you can't win that argument. And so it's complex for sure.
Layer 1 is a podcast and community dedicated to helping you master all things crypto. We'll be bringing you the best interviews with project executives, technical analysis for trading of the most popular cryptocurrencies, and insight into what's actually happening behind the scenes.
As you join us each episode, you're going to hear about tokens, fundraisers, investments, and even crypto conspiracies. But please remember that nothing we say should be considered financial or legal advice.
Come join us on this journey and welcome to Layer 1. Good morning, good evening, and good night. It is another episode of Layer 1. We took a week off here for a second. We didn't have a guest last week, but we got to bring you the best, and that's what we're doing with this episode. Shout out to our lads community, guys, as you follow along. Thank you for participating and kind of engaging with our content. We appreciate you guys so much. So I got to get over to Dimitri before we introduce Konstantin. But Dimitri, what's going on in your neck of the woods, man?
Yeah, what's up, everyone? The duo is back. We're doing another interview. Obviously, we have an exciting guest. So it'll be interesting to talk about the macro stuff, the stuff that they're doing with the nodes, decentralization, all that and more. Who do we have to?
Yeah, we've got Konstantin Richter. He's the founder and CEO of Blockdaemon. They provide node infrastructure for businesses and enterprises, but I'll let him explain it. He's going to do a better job than me. Konstantin, what's going on in your Airbnb today?
Yeah, thank you for having me. Very excited to be described as an exciting guest, as a middle-aged German guy. That's not an adjective that gets thrown at me. And so, yeah, I'm sitting in an Airbnb near my house, out of which I operate during the day because it's crawling with little children. Yeah, I'm the CEO and founder of Blockdaemon. Appreciate the time. We're an infrastructure provider in the blockchain space. There's a lot of different ways and one-liners. We constantly reshuffle. Ultimately, we're all about node democratization. So we want to build tooling that allows for open source decentralized networks to operate efficiently, right? And so what that means is, there's a multiple different variances of tooling and decentralization grades that we think through. The most popular one and the one that people see the most are managed node services, which operate on our hybrid cloud that we run for, investors, for foundations, for enterprises, all sorts of different people. But ultimately, lowering the bar and barrier of entry for institutions and individuals, ultimately to participate actively in what we call network custody, right? So securing and monitoring decentralized networks.
Yeah, I want to get into the tech behind what you guys provide for these enterprises and these businesses, but I have a great conversation to get to as well on protocol governance. I feel like that has really come to maturity as we kind of see these protocols come to maturity. We've seen foundations completely dissolve into DAOs. So this is going to be an amazing conversation that we're going to have, and glad to have your experience on the podcast. But before we get to that stuff, I want to hear about your background. How did you find yourself in tech? How did you find yourself in crypto? And then we'll make our way into Blockdaemon.
Yeah, it's it's a set of funny coincidences and accidents, and then I got very lucky a few times on the way. And so I'm from Germany originally, and I started my career working at telcos, building out networks. I was always interested in connecting folks and people, and so back in the day, those were actually wireless networks specifically. That's where I came out of, Deutsche Telekom. And then Nokia. I worked for I was assistant to the CEO as a younger man at Deutsche Telekom. I worked at Nokia, trying to kind of build software strategies across hundreds of different devices, and trying to really bring the promise of software to these sort of new distribution channels, right? And so became an entrepreneur around a decade ago, all around the concept of distribution of content, really, ultimately. So large sort of infrastructure components that host content, either music, video, pictures, that then gets reformatted automatically and pushed in different distribution channels. And so always on the sort of transcoding, hosting sort of side of things, and I've built a few companies in the space. And back in the day, the magic word was network effect. Network effect was when, you know, you kind of sort of hit some form of scale that was automated, like you had nothing to do for, you know, the more people buy it, the more you sell. Actually, network effect's very similar in music to the chart effect. Once you're in the top 10, it's sort of a self-fulfilling, you know, kind of more people see you, more people buy you. It's sort of kind of, that's what you're aiming for. And
network effects, we're in crypto.
That's right.
What are network effects? Go ahead, sorry.
And that's how I ended up here, ultimately. And so back in 2010, you build network effect by offering a software utility to suck up, you know, content or you know, kind of like tokens. And then once you had enough of them, you could create a marketplace. And so, and that was always the business model that we were chasing. And so I became aware, you know, I bought crypto. I like Bitcoin, you know, I bought some Bitcoin early, and then had software companies, and had my last exit in 2017 when, you know, it was clear at that point that my next venture would be a blockchain one. I've been structurally involved on some boards and like thinking about stuff since 2015. I had some sort of stake in different ventures. And so in 2017, I felt the time was ripe for, you know, me to enter the arena as an entrepreneur, meaning, you know, starting a company and going on the path of being a founding CEO again. And so, you know, really my kind of genesis block of Blockdaemon was very simply also part of I remember you guys back from the ICO craze days, you know, structuring, you know, token sales, which are ultimately also forms of governance, right? Like distributing tokens and alignment and building alignment across software projects. And as part of that, we were running some Ethereum nodes for some projects, and it was just excruciatingly hard, and they kept on crashing, and it was really difficult to keep them in sync. And so it became very clear that in the sort of exuberant market valuations and expectations that were created, that the technical reality of a lot of it is very shaky. And so I looked at it long and hard and thought it's probably a good idea to bridge that delta, you know, the sort of shaky infrastructure and exuberant expectation. And so Blockdaemon was created to fill that void. And in its most simple form, you know, we're a hybrid cloud infrastructure company. You can go to our website and deploy 70 different node types with 3 clicks of a button across 100 data centers that are all pre-configured, right? And so those are all managed nodes. Ultimately, what you pay us dollars per month is the management, not the physical launching and deployment. That's actually relatively straightforward. It's the never having to think about it again, because these nodes need to be kicked and shaken very regularly, because in a decentralized reality, they need to be connected to an evolving set of peers. There's new nodes coming in, there's new software updates. You need to be connected and have the right software update with the right group of nodes. And so there's a lot of organization to be done. And we just take care of that for people. And mostly those are professionals that pay money to avoid the pain of spending time, right? And so those tend to be institutions or enterprises. And the definition of enterprises is, you know, we can argue about. We have some Fortune 500s, but, you know, it's not a huge market for us. Our largest enterprise type customers, actually exchanges, custodians, financial institutions that are actually active in the space. But
Yeah. Around that initial discussion of the genesis of Blockdaemon, I know in our research, you had talked about kind of losing sleep over maybe making the decision to offer enterprise and not retail, and kind of, did I make the wrong decision? So in that genesis discussion, kind of what was your thought process there? Why did you go the SaaS route for enterprise as opposed to maybe offering SaaS for the retail investors and the retail crowd to maybe get involved with staking and the like?
Well, yeah, and it's a fair question. You know, it wasn't as linear back then, and so ultimately, when I think what's a little unique with us is that I really wanted to build a software business more than a crypto business, and so I needed to have a strategy that had a monetization strategy that was current and relevant, and you know, and so very often when you do that, and specifically when I started, there wasn't, the ethos in the crypto community was very much around you run your own nodes, and so the people that paid me to run nodes were a little more enterprisey outside of that, who wanted to sort of get a feel for it and then see if they engage more or less. But that was sort of the first customer cohort. And from a positioning perspective, what I liked about it, and I still like, is that we're really a first-class software house that brings software principles around network strategy and network orchestration to blockchain, right? And so we combine both. Like, we're not a native crypto company. We're actually much more native around providing excellent network infrastructure. And that was a good strategic starting point for us, because what you see now is that what we've anticipated quite well is that all these decentralized networks have huge performance issues, mostly because it's like any open source project. There's a lot of participants, there's a lot of different ways of doing things. And in the ethos of these decentralized networks is a lot of variety, and it does impact performance. And so there's a market here to try to, how do you try to increase overall performance of a decentralized network without impeding on the security of the network? And so starting from an enterprise component here was smart, I think, from our perspective. We've shifted a lot since, and so our long-term ambition is to be the Datadog of blockchain. And so what Datadog is ultimately a monitoring dashboard across a lot of different nodes, right? And so that's kind of where we see this go over time. And so, but because I'm a venture-backed entity, I need to have a business model. And I think one of the things that are also fairly unique about us, not so much anymore, but it used to be, that I actually, I have MRR, revenue per month, all the sort of traditional software metrics that were a little foreign to our ecosystem early on, and so when you look for paying customers, we had to dig really deep to find them. It wasn't an easy exercise. And it's gotten a lot easier since, mostly because all these foundations and POS networks and nodes have people are a lot clearer on what nodes are now than they were back then. But so for us, it was a starting point. And what that meant was also we took money initially from non-crypto investors. So our lead investors, Comcast Ventures, we took money from the Roku founders, from Boldstart, some great VCs that are really focused on building software tooling. And so, and that's sort of at the core of our DNA. And from there, we move into blockchain and crypto and decentralization over time. So think of us as an entity that becomes more decentralized over time. And so I'd say, so we started from a fairly central point of providing high-end security and performance for a limited amount of networks, with a lot of control, and then over time have expanded that into more tools, more protocols, better understanding on how to operate across more nodes in networks where the tooling needs to be abstracted away a little further. And and so we have, let's say, in my first year, I ran 25 nodes. Now we run 1,500 nodes or something. So we're growing like a decentralized network in a way, with the same complexity, across all these different protocols.
Just for our listeners, let's break down, these enterprise customers that you work with. Are they more interested in public blockchains that we're kind of familiar with right now that are existing, or do you see interest in private blockchains setups, maybe on their private level where they need to just internally make things better rather than have a public blockchain? What do you see there?
Yeah, great question. I mean, the answer is it varies so much based on the use case. I think we see demand on all of them. I mean, the most nodes we sell are Bitcoin and Ethereum, just by, those are actually the networks with the most nodes. There's the most applications built on top. Every exchange and custodian trades them. And so we do kind of follow that a little bit. I would say that the common industry practice and the understanding at this point is that progressive decentralization makes sense. So a lot of networks start centralized and move towards decentralization over time. And so what I would say is not so much, it's not one or the other. It's we support, the way I think of ourselves, we support, let's say, 30 different protocol out of the box, and they're all at different stages in their decentralization, right? And so it varies per protocol, right? And so we do have demand. There's large networks that are totally locked in, where people are like, hey, there's going to be 100. I mean, actually, even most POS networks, can't handle any more than 100 validators. Like there's a sort of hard cap amount of nodes that are currently allow you to function. If you want to function the way they do, which is always clear, like we need more throughput than Ethereum. And so there's a hard cap number, and that's really pure network architecture and math that allows you to do that. So even if networks say they're very open, architecturally, like there's a couple of hundred of nodes that ultimately carry a network at this particular stage. And so I'd say, so it varies. I think specifically, we're excited around our payment networks, the Libras, the transparent systems with Zan tokens, mobile coins, Cielo, all these sort of projects that actually have a product that's relevant now, which is payments. And in those, decentralization is complex because it comes with a lot of responsibility. You actually carry revenue and value on these nodes. And so a lot of the times they start small, and it's a lot more sort of centralized. There's 5, 10 nodes, maybe 20, and then they slowly cascade out. And so I think you'll see that's sort of the current way of operating. I do think that networks like Bitcoin and Ethereum, I think that's hard to replicate. You see a lot of that now in the DeFi space, where ultimately you can try to start these things by making exuberant value available to people. So they all coalesce around a project and launch a bunch of stuff and try to take advantage of that. But that doesn't necessarily build good long-term networks. So I think still the common best practice is you start centralized, you progress over time, and move towards maybe a DAO later on, even though there's still a lot of questions around DAOs, so we'll talk about that. But so I'd say, banks and folks are very interested in Bitcoin and Ethereum and the sort of larger tokens, right? Like the exchanges and custodians, where you see a lot of volume. And then you have the VCs and more sort of kind of disruptors thinking about payment structures and adjacent companies to that. And then you have the traditional enterprises who are looking at supply chain use cases and stuff. And I'd say that has cooled down a lot over time, at least from my perspective. But there's still work being done. We're just sort of understanding that it's, if you can't fully decentralize a blockchain network, there's no need to do it. And so I think enterprises are understanding that the value proposition is not easy to achieve. And so because they have security standards that require them to be centralized, and it doesn't work with blockchain. Like you can't be centralized and have a decentralized ledger. And so, so it's just like, it's just complex to make work for them.
Yeah, I'm surprised actually that supply chain didn't really pick up. That was, like a big thing that, everyone's kind of screaming and saying, hey, how much the supply chain can actually benefit from this. And it's interesting how that kind of, slowed down there. So yeah, there's, tons of questions about what, you just mentioned. I wanted to also ask you, when you say that, networks typically kind of start more centralized and then move into decentralized, setup, looking at some protocols, it seems like the opposite effect kind of happened. Looking at, like, for example, some protocols that attract more nodes that get set up with AWS, and then suddenly you have like 90 nodes that are set up on AWS, and then you have 10 that are running like properly decentralized. And then also you have then all these exchanges, let's say on proof of stake setups that take over the network, like the EOS, let's say it has the 21 block producers, or maybe some different protocol that has these big players, these big exchanges that come in and they basically take over as validators. And, then it's like, well, if those guys are working together, there's, could be collusion, all that stuff that could come into play, how much of decentralization is really there, and so on. What is kind of your opinion on that kind of?
Man, that's a great, I mean, it's such a wide discussion, right? So first off, I want to say that decentralization is a philosophical absolute, right? So you need to have the right degree of decentralization based on the maturity of the network, right? And so it's important to understand that decentralization in itself is nothing, like kind of you have to see it with where it's at. And so so let's do them one by one. So first, you talked about a decentralization around, for example, a cloud provider, right? And so I think and that's a common one. That's relatively easy to fix. And it so far actually has created a lot less risk than a lot of other forms of decentralization, just to be clear. And we're actually, it's the easy one. We actually started as the first hybrid cloud provider where you could automatically manage node distribution across Amazon, Azure, Google, and like that's an easy thing to say, like, hey, you got to have them on different infrastructure providers, and it's true, right? Like, so a lot of projects that we work with now actually have very clear quotas and targets around, you know, how many nodes they want on AWS, and there's not just the cloud providers, there's also regions, so it's actually more like the individual data centers. And that's something I think projects are managing a lot better than they used to. I think the bigger points of failure actually are a lot more in the governance around tokens. So for example, right, like I think the custodians and exchanges are actually probably a bigger risk factor at this point in time, because, you know, ultimately the lucky part for us was, so far at least, Amazon cares very little on what goes on in their data centers. You know, they haven't pulled that muscle. It's not like that they were like, hey, we looked at all the different nodes, we shut down Ethereum, which, you know, has a lot of nodes run on AWS and stuff, and that just hasn't happened yet, and we don't want it to. I mean, I'm not saying it's not a very good cause, but what I'm saying is you can manage that a little bit at a later stage. Much more important early on is the economical fairness and distributions of tokens and the consensus mechanism, right? Because what happens a lot of the times is most people don't really care about governance or the networks, and I think one of the problems we have is there are a lot of people who just want to speculate and make money.
Yep.
And you see that in a lot of the DAOs. It's a big problem, is that not a lot of people actually participate in the actual governance. And we see that in a lot of projects, right? And so what happens in that case is people put their money on an exchange, and then the exchange run nodes, and they just have an exuberant amount of tokens, and ultimately they control the network. Yep. They don't pull that muscle, but it's a lot easier for them to play that game than for an Amazon, for example. The consequence on, you know, like for Amazon would be like, I mean, yeah, it's much less a risk factor. The risk factor with Amazon was when Amazon East used to go down once in a while. You know, a lot of blockchain networks went down because that's kind of sort of where everyone threw up their nodes. And so, but so I kind of feel like it's the degrees of urgency are change over time, right? And so I think the cloud provider is a nice one as a flagship. We can say, oh, look at this, this is not decentralized. It's often very, you know, the real issues currently lie elsewhere. And I think a lot of it is governance participation. A lot of the times it's actually people really caring about a network. And ultimately, you know, it's just hard to build an ecosystem of people who truly care and build applications on top of these networks if you're not Bitcoin or Ethereum, you know, and so that's just the way it is currently. But yeah, so there's different subjects there. You can break down decentralization even on a software layer. Docker, there's tools we use in the open source universe. We use a lot of centralized tooling as software companies to deploy decentralized applications that are single points of failure. People don't talk about that. Docker could be a point of failure. You know, there's like you can dig and look into this thing, and you'll always find some discrepancy there. There's a saying in Germany that I always like to use. There is Bismarck, who was a famous chancellor in Germany. He always used to say that there's two things that people should never know: what goes in a sausage and how laws are made. And it's a little similar with blockchains, you know, because the reality is that we don't really have the principle of decentralization is currently not fully applied in any blockchain project. Mm-hmm. Like it's a myth, right? Like, I mean, we can talk about Bitcoin, the most maybe decentralized one, and there's 3 mining pools in theory who kind of hold all the power. You know, like there's just, you can't win that argument. And so it's complex for sure.
I think Andre, I don't know if you've seen Andre from Wi-Fi. I don't know how deep you are within DeFi, but Andre kind of flipped that on its head a little bit, and it's seeing some success. I can't speak to it in depth, but I think he did kind of flip that on its head and kind of distribute everything immediately to the community, and they've seen success, which is not something you see usually. But right. Past that, and we'll get to the DeFi discussion here in a second. I think there is two separate things that we need to talk about, right? We have the technical side of the infrastructure that you provide, but it's the governance infrastructure. I think that is way more like beautifully complex. And I want to talk about your experience kind of from 2017 and how you've seen governance through the years kind of mature. What are the specific, maybe at a specific event or just the macro kind of landscape? How has it changed since 2017 to now?
Yeah, it's another great question. And let me also say this. So I think that governance for us as an infrastructure company is going to become way more important than it used to be. And so I actually think a lot about our own product offering around governance. Now that we run a bunch of nodes and we are influential on networks and stuff, it's actually, as a community, we have a responsibility to live governance effectively and allow people to exert their power of governance, right? And how do you actually do that? How do you inform? How do you build interfaces that make it easy for people to participate in governance and stuff? And so I think that's going to be one of the areas we think a lot about in our product as well. And as well as clear sort of proxy rules, like if you work with a centralizing agent, of which we could be understood to be one, what conditions do you give us and rules do you give us to participate on consensus on your behalf? And how does that look? And how do you automate that? And how do you build it, maybe a DAO, like a smart contract around it, right? Where you can purchase a node with a smart contract that dictates, you lay out, like, this is how I want this node to vote. You can operate the node, but the vote is very clearly defined on what it looks like. And so I think a lot about that. But, and so I think to that end, I think it has shifted a lot, where we see a couple of things. So first off, governance now is a reality more than it ever was before. I think we see that governance is not is problematic, because I think in most cases we see too little governance. So very few people are actively pursuing governance. We see that in POS networks, where people have to get paid to submit proposals. It's actually hard to get more than a sort of core group of stakeholders engaged, right? And that's an interesting complex fact based on a lot of how these economical systems work, because it's the big guys who own a lot of tokens who care, because they don't want to lose influence. And so there's this interesting threshold of distribution of tokens to more and more people over time, when you have a lot of financial institutions holding a lot of tokens that still think in this like a single sum game theory, where it's like, I want to win, and I have this discussion with a lot of investors, like as a validator. Let me give you an example where I feel that as a node operator in a POS system, for example, one of the things I find very curious, that we have a lot of investors coming to us and our competitors to introduce really heavy competition on fees we charge for validator nodes. So the whole idea for these networks for a long time was, oh, we're going to have these validators and there's going to be a lot of competition. They're going to drive down the fees. And so it's going to get, ultimately, like, they charge very little to operate these nodes. And it's actually really not in the interest of any of these networks, because ultimately, when investors start driving down the cost of validation, they drive down the quality and the resources that get allocated to actually physically secure the network. And so there's these sort of weird instances where I'm like talking to huge investors and I'm like, you're hammering me on a price where like the margin is so low for you, but it's so vital for us to have a thriving ecosystem as a validator, where like you're damaging the network with that. Like, what's your role as an investor to also ensure that a network is decentralized and protected? And I think we're still very early in making investors understand what that looks like. And so I'd say it's becoming an issue more and more. I think awareness on how to fix it is complex. I think there's obviously progression. I think Cosmos is a good example of a network where just because it's been around a little longer than most others and has a thriving community around it. And Cosmos is a wonderful project that I really care about. And I find it really fascinating. We're not overly active in it, but I find it so fascinating that it has such a strong, it has a good, strong developer ecosystem, but it also has huge centralization issues because the way the network was designed, people, it's purely, the top 5 nodes can decide whatever happens in that network, and it's just, it's hard to get those economics right. So, but the point is, if you just, and it's actually interesting, even with a DAO model, if you just have economical incentives, they tend to be kind of one winner takes all. It's because that's how we reward everything. And so those models don't seem to work well either, because ultimately the way you want to, and that's would be my critique of DAOs, where you have to be really careful, is, and why, for example, I like Libra in a way, it probably makes much more sense for a lot of these networks to think through, if I only have 100 validators, 100 network custodians, people who make the core transaction layer of this network function, isn't it better to make a list of 100 entities that I think represent a spectrum of users over time that carry that responsibility? And so, you could say that's what a Libra does, right? Like they're like, hey, these are association members, there's payment companies, there's whatever, some crypto companies, some university projects. Like we take different custodians and we think that makes a good mix. That's not a bad approach, because the alternative very often is you'll end up with 50 exchanges, 25 custodians, and 25 investment funds. And all they care about is transaction volume and token fluctuation, And so what I want to say is, I think we're maturing a lot in understanding the issues around governance. I think we're making a lot of strides to find new ways to experiment with it, with DAOs, for example, which are big subject specifically around DeFi. And so but we haven't found an answer, I find, that is actually acceptable.
Yeah, absolutely. I just want to follow up really quick, on what you mentioned about incentivization, about the fees for, some of these validators, once those really undermined, maybe, let's say, maybe the token price drops, or maybe the actual rewards become less, then that kind of starts impacting the quality of the decentralization of the nodes and so on. And then, also what if like the transactions, how does it impact the transaction, especially in like the payment sector, right? So you got to have the high transaction output, but also the fees have to be really kind of low, right? Because if you have a lot of transactions and the fees are high, like, good luck getting the payment processor to work with you, right? So kind of what is the balance there then? If you want to have a lot of transactions, low fees, enough for these microtransactions, and then have rewards for these nodes and decentralized networks.
I mean, it's a great question, and there's a lot of different answers. You can have a central agency rewarding people accordingly, which is how most projects operate. They have a foundation, and in that foundation, a bunch of funds, and they sort of jump in and try to balance it out. But it's very hard to automate it. And I haven't seen, look at Ethereum right now, right? Like, it's interesting, like the gas prices are going through the roof. It's like, it's so fascinating because it is so inherently complex, because the free market dynamics don't really work in this environment. And so I always the reason why I like it is I kind of feel like, on one hand, we're so liberal as crypto people. We want this total move away from any sort of central authority. But then the only way this works, if we have kind of socialist rules enforced by something that's sort of decentralized. It's kind of super fascinating. Like, it brings like a really interesting systemic debate, because you need some social conscience and responsibility, because otherwise it just doesn't work. And so, but then who instills that? And that's why DAOs are interesting, because you're like, well, there's a piece of software that does it, it's so incredibly hard. And also exciting.
You mentioned Cosmos as maybe a protocol that's doing governance well. Since your time in 2017, who else has maybe done it well? Maybe name drop one more protocol. And if you can, name drop a protocol that maybe is not doing governance well at all, or didn't do governance, or had a misstep. If you don't want to answer that last one, you don't have to, but I'm going to throw it your way.
Yeah, sure. I mean, well, there's a couple of things. So I'm just pointing out, like, Cosmos actually has a lot of issues around governance, but at least they're openly debated, right? So there are people in the community now talking about, like, hey, we're a top 10 validator, we're going to reallocate stake, and like, there's a debate about it. It's visible, there's networks like XRP or something where you don't have that, right? Like, the debate is external people. The internal people operating it, they're not debating it, And so I'm not saying that that's bad because Ripple also is really very clearly industrial enterprisey type of use case for financial institutions. So they're kind of like probably thinking, well, you know, we don't need this to be decentralized among a wide variety of people. We need it to be decentralized among the 10 participants that might use or not use this network. So I don't want to judge it. I just want to say that the health of the debate is not decentralized, you know, like it's not that. And so I think Cosmos at least is having an active debate about those things. I think there's networks that have done it. I'm kind of thinking, you know, I think Ethereum somehow managed to defy all odds. DeFi. Oh.
It had to make its way into the conversation.
But you know, kind of, I feel like Ethereum somehow kind of is interesting still. Like I feel like it's a really misunderstood protocol, by a lot of people. And because I mean, I'm a Bitcoin guy really, but I'm also, you know, like I love really what Ethereum is, and so I think. Specifically with ETH 2.0, there's going to be a lot of interesting questions that will have to be answered, and that we're going to see a much larger sample of what that looks like. But yeah, I mean, EOS, you've mentioned, obviously, probably a project, you know, but then you have to ask yourself, what was the goal of that project? The guys who built that project, they're doing well, you know, like from their perspective, they're just decentralized to the right degree, I guess. For everyone else, you know, maybe not so much. You know, I do want to say that it's kind of, it became this sort of simple stick to hit other projects with. It's a little bit like, you know, oh yeah, this other project is just not decentralized. Like that's like it's never your own project that's not decentralized. So,
yeah, there's a lot of stone throwing, man, and I liked your point before about how someone has these ideas unless it kind of infringes on their own ideas. I'm a libertarian until it doesn't suit me, but definitely. So one more question I had based on the EOS conversation, because I think there is something to be said about leadership within these DAOs, right? I think a lot of decentralization maximalists will say the community needs to handle this, but a lot of what you see is the successful projects, they have, you know, faces of the franchise, what we call them. They have people leading them, right? Ethereum is led by Vitalik. Cosmos has a various amount of people, Synthetics, Kane, and you have all these people who are leading their respective movements. So I wonder what you think about that. Do eventually, as the foundation kind of dissolves and moves it to DAOs, will there still need to be a front-facing figure that needs to be in front of these different entities?
Well, there shouldn't be. So let's just say, obviously, the idea should be no, because it's always the question. I mean, I'm not going to, let's just say, you know, like if you have people like Vitalik, obviously you have a single point of failure that's massive. You know, if something happens to him, or like, God forbid, he gets sick, or, you know, like kind of like it creates a risk factor, obviously, into the network that is large. And so the idea is no. The question is, how is it possible? And I don't know. I'm really excited to see some of the later stage project, like some of the projects go live, like MobileCoin. I really like, for example. It's not a well-known project, but I think they have really interesting ethos, and they didn't raise a ton of money. And so there's these projects where I think the governance could be interesting within a foundation. And not to have a single person, but like a group of people that dynamically get voted in. You know, we'll see how that goes. But obviously the big thing are DAOs, right? So everyone is talking about DAOs and DeFi, and they go really well together. And that's currently what everyone's throwing money at, right? I think the challenge there is that a lot of the times, actually, I think the people that are the spokespeople, like Vitalik is a good example because he's a great spokesperson. Let's just talk, you know, like kind of just give the guy some credit. I mean, as a protocol, this guy cares about the protocol. He's the least money-focused person you'll ever meet, because if he were, it'll be a very different story. And so I think the community is very lucky to have him, because in other networks, very often the core motivation is let's make a lot of money fast. And like, yes, like we try to find a new backholder and run out of here and make out like thieves. I mean, as a community, listen, hey, I mean, greed is a big, big driver of a lot of the innovation we see here. And so I think it depends a lot on the type of leaders you see. We work a lot with universities. We try to get academia into these projects a lot more. So try to find the right balance of stakeholders. But I don't know how you can do it without having some form of democratic vote where certain stakeholders get elected to participate in governance decisions or the structure of the DAO.
Yeah, and as we kind of got into a little bit of into DeFi, I wanted to jump into that. And specifically to the point that you made about the greed. There's that big saying, "Greed is good." From Gordon Gekko back in the day. So right now, speaking of DeFi, if you take a look, right, with the governance and what we have set up, we have the governance tokens that are coming out, and everybody's quickly jumping in on them, but it's mainly, just speculators that are trying to get in and just make money there really quick. The question is like, well, once that kind of stops, who's going to be there actually, in there as a user to use that token as a governance, and what is the percentage of these speculators compared to the users that are going to stick around? It's essentially like a big experiment in the end, and in general, kind of my feeling is that overall, with certain bubbles like that where it attracts speculators, there is a good side to it because they tend to broadcast and get reach more eyes and so on, attract new capital like investment and so on that comes from VCs and funds. But then what is going to be kind of the outcome of DeFi, once this kind of thing slows down and people realize that, hey, listen, the whole thing was just kind of a speculation, but really the actual users of the governance token are not there, right? There's no stickiness to it, right? They're just, people are there for the moment to chase the yield. And then once, they kind of leave, then does the whole thing kind of stop, or what happens?
I mean, hey, you tell me. I mean, my assumption is that mostly it will stop.
Mm-hmm.
I have to see, I have to be convinced of the difference. I think definitely, because obviously we're part of the community of, we talk to a lot of VCs and we raise money always, and we're part of a lot of discussions. I definitely feel it feels a little hypey right now. I think a lot of there's a little bit the sort of ICO-y question mark hanging around it, where I think a lot of the more traditional investors are a little bit, these look like tools for some folks to make a lot of money quickly. I think empirically, we're just going to find out with time who remains true to the initial principle and who doesn't, and it's so interesting to deal with value. I was thinking the other thing, while you were speaking, it's interesting, that we don't have the concept of kind of the minimum income sort of type of thing that happens in politics. Is there a way to structure a network where everyone gets the same, but at a huge quantity, of people, kind of where it's which maybe ETH 2.0, where the staking requirements are quite low. Can you have every participant gets a fixed amount of tokens, and then they can participate with it, they can sell the tokens, they can proxy them, they can do a bunch of different bits, but there's a lot of models we haven't tried yet. I think as long as you have large investment entities or foundations controlling double-digit percentages of token reservoirs, you will have abuse, right? Just because, and I mean, I get it too, man. I have 2 kids. If you give me an opportunity to hey, I can, kind of make 50 million bucks here and never have to worry again. It's a hard thing to ask people to not do that if they can easily get away with it, and so the way we create fear and the way we build our societies, it's just not conducive for that type of incentive structure. And so I'm fascinated, man. I find the VC landscape super interesting, combining that with token stuff. I do feel we need some crazy ass socialist sort of minute, kind of.
You heard it here first.
Yeah, like an AOC type of lady who comes in and is just all about equality and kind of really making sure that minority interests are maintained. And yeah, and I'm really intrigued to see how that all nets out.
Yeah, this DeFi in this governance discussion, I mean, you hear it so much. What are we saying? We're saying I don't know. We're like, this is just an experiment, as we're saying. But I love the actual conversation. So I do want to kind of get to staking a little bit and kind of get your kind of input on where you think staking is. I think on the run up to 2020, staking was becoming it was about to have its moment, right? It was like chase the yield here, secure the network, stake your tokens, get a yield that maybe you're not finding out in the traditional markets, and we'll have a happy little ecosystem here. And then DeFi came in and just completely stiff armed, it feels like, staking out of the way, although obviously it's more sustainable.
Yeah. On the yield side, right? Like, so I think the true capital still sits mostly in the large POS systems on a very different scale, right? Like, so I think those don't necessarily overlap, because the large investors in the next new generation of POS networks are the Andreessen and Horowitzes and all these large investors who, they dabble in DeFi, but they're also not like core players in that particular segment. So, I mean, for us, it's different because a lot of the POS networks are now just going live. And so for us, like, kind of, if you look at this month alone, man, I mean, like look at all the big networks, Solana, Near, Keep, Scale, Oasis, like there's all these like super heavily backed networks going to mainnet. And so we're at a unique point where a lot of value gets thrown into the market. The interesting question is how much then, once it's liquid, gets pushed into crazy DeFi projects because people are chasing much higher yields, right? And so that'd be interesting to see, because there's probably going to be, I don't know, $5 billion new liquidity getting introduced in the market every month by just these huge networks launching, where, investors made huge commitments in 2017 when they had a lot that's been locked up ever since. And so the question is, what happens when those become liquid? And it's interesting because a lot of these foundations are really well capitalized. So they think a lot about when a secondary market, how do we do market making is much more common nowadays. They can manage prices of tokens with lockups and other bits and pieces. And so it'll be fascinating to see how that evolves. For us, staking is very consistent revenue. Because it's somewhat predictable for us, and so we like it just because it gives us a hand in the cookie jar for token value, because normally we're charging dollars per month per node, but then we also make yield, and so we end up with a bunch of tokens where we need to figure out what to do with them. But it's nice to at least have, hey, if any of these goes 100x, like that, I'm a venture-backed entity, I can always use capital to build new products and stuff. And so it's nice to have that potential outside of exponential growth on the software side, because we're still very early, right? Like, just to be clear, like the core group of people engaging in all these large networks and stuff, it's relatively small. I see a lot of the same faces, man, in all the same kind of like big projects, it's like kind of, oh yeah, here you again. So it's, there's just so much more to come. I mean, we're so early, but yeah, I mean, I'm intrigued too. I mean, obviously we're looking at the DeFi stuff. We have a couple of plays there on a node level where we're trying to facilitate interfaces between, like, when people kind of mine, you kind of put on your Ethereum and you mine whatever Bitcoin, and all that type of stuff is interesting to us as a function. Because we can build different products and interfaces around it that we can sell. Yeah, and so I don't know, I'm intrigued. Stable token, but there's also, and then you have the whole stable token universe.
Yeah, there's a lot. It's growing. This bubble, not, I wouldn't call it a bubble. This bull run, this bull cycle, whatever you call it, it seems like so much more hectic than 2017 because you have all these products out there, and it's just hard to keep track. I did want to get your opinion. We're kind of coming up to the end of the episode. I got a couple more questions as far as staking and node governance and all these things. Back to Dimitri's point earlier, where people are jumping around from DeFi platform, trying to chase the best yield. Well, now, yeah, obviously you can do that in staking and chase APR there. But there are products that are doing that robotically now, doing that with algorithms and what have you, and bots. What does that do to the security of these different networks? Is it not big enough to actually make a dent, or is that actually a problem when you see all of these tokens being staked and unstaked, or whatever process these bots are using. Does that kind of compromise security at all?
Yeah, I think I mean, theoretically, yes. I think it's always complicated. I mean, so it's good and bad, right? So because before that, you have two kind of weird phenomena in staking. So one is that normally when large investors stakes their token, they kind of never move around. And so it's like, because actually, you know, the reality is like we work with some large funds and we manage an enormous amount of assets. And there's a lot more goes into it from a large fund perspective with who they can stake to. You know, it's not like a retail sort of function like staked. It's more, you know, individuals who, you know, can just throw their tokens wherever. A lot of the larger investment funds have very strict rules and requirements in what they need with regards to insurance, with regards to background checks. Like they need to know exactly where stuff is at any given point in time. So there isn't actually a lot of flexibility on those. And that creates an issue too, because then you have these huge token allocations sitting on individual nodes, having a lot of network power. And what we've seen, which is one of the reasons why everyone initially, a lot of the validators cut a lot of costs, because it's a little bit of a land grab. Like you want all the large investors ideally on your nodes, and then you kill everyone else by collecting, you know, by introducing a very low rate of return because you have a large stake, until there's very few providers left in theory, and then you increase costs. And so that's what happens when you lower the yield over time. And so I like the sort of restaking of that is good. Like if you have tools that go around, I think the biggest problem for me is that it's connected to the rewards mechanism of the protocol, which is how do you make the best returns? And so if the protocol rewards validators who are run very securely with a disproportional amount of yield, then those tools can enforce that behavior, right? And so that's really where the connection is. And so it can be good, but it can also be bad, because very often it's like, it's not really aligned with it. I'd say newer projects like Cielo, for example, does a very good job with that. Like where, you know, node security and performance are directly correlated to the reward you earn. And so they have certain wallets that automatically distribute tokens to the highest yielding validators. And those are the ones that actually run the most securely. And so it's not in itself good or bad, you know, it depends on how it's executed.
Yeah, it's like adding a reputation system, essentially. I appreciate that. I guess the last question I had, I know we threw a lot at you at this episode. I'm interested, obviously people in crypto are inherently kind of global. They have this global mindset, right? Of being able to interact with people all around the world. I mean, we're talking to people in Europe and Asia, everywhere. And I wonder how protocol governance and your ideas around that, how does that happen? And I'm going to use EOS as an example here. There was a very big kind of event within EOS as it was launching in like an East versus West fashion, and that there were cultural differences on how nodes should be run, on the rewards that one should get. How do you deal with protocol governance when you have a global governance system and you have to mesh different cultures together?
Yeah, I mean, good question. I mean, and we're learning that in real time too. You know, we actually have a lot of Asian investors in our last round. We consciously looked for a lot more exposure in that respective market, and it's a very different ecosystem. Like, like Korea is a very different market in how they think a network needs to be operated. Often much more closed culturally too. You know, it's not easy to be trusted in those respective networks, and so I'd say. I have no answer when how you manage it outside of, you know, you try to be open-minded, communicate well, be respectful, and ultimately the principle of protecting network performance and security over time is true for everyone. I think and so I'm thinking a lot about, for me as a company, where do I need to have a presence in order to actively win business and participate in these decisions. And so for us, we have an office in Europe, we have an office in the US, and we have an office in Asia. And so we've made the choice. And when I say office, obviously nowadays, you know, kind of what it means. We have a Zoom. We have legal structures in place to deal with people locally and pay people who are local to engage with local communities. And so I do feel it's a factor for sure. And I think a lot about that, because I can think a lot about how do I scale my own business. There's definitely value in a local presence in each market, because our business is also still very intransparent. It's very relational. It's like, I know, like there's very few true RFP processes in this business, like it's mostly people know exactly who they want to work with. And we're all kind of intertwined. Like, I have a bunch of investors. They're never going to give their tokens to anyone else. Even if we have an RFP process, they're like, sure, you guys run them because we own equity in you. And like, I'd say each large investor in the space has that set up already. And so it's a lot less transparent than people think, and so I think figuring that out actually as an industry is also really, really important. I'm always frustrated when I hear it. I'm like, oh, wow, a huge exchange partnered on this. And I'm like, I didn't know that was up for grabs. Just to come and pitch. Like, there's no process, there's no visibility. It's all like, and so I think that's one area we want to work on is how do you build DAOs around RFPs for running infrastructure, for example, right? And how do you actually do that in a solid way so there are no back payments and all that type of stuff? I mean, lots of work to be done.
Yeah, absolutely. And I love all these conversations. Konstantin, thank you a lot for sharing all your insights. We have also this last question that we ask our guests all the time. And it's a book recommendation. So it can be related to crypto. It cannot be related to crypto. What is kind of something, could be recent or older book that you read that, you would share with our viewers?
Yeah, I got a really good book, Capitalism and the Innovation Economy. It's an old book out of the 80s, early 90s about Silicon Valley and like how to apply capital to achieve innovation. And it's so true still, like kind of how do you actually combine those two? And so I always think of that as an interesting governance, a book that has really interesting insights into how to use money to further innovation, which is kind of what we do, right? And so there's interesting learnings there. I think it's important as an older person in this ecosystem in my 40s. There's been very smart people building smart things for a while. We haven't invented everything from scratch. We're standing on a lot of smart people who've had some really smart thoughts around governance and all that type of stuff. And so have an open mind, and there's some good books to be had, but check that one out. And I can send you guys a link to it if you want to drop it in the show notes. I found it really insightful.
Awesome. Yeah, we definitely want you to drop that in the description. We appreciate, like Dimitri said, you coming on the channel and trying to solve all of the universe's problems here, at least the crypto universe's problems.
Yeah. And run nodes, guys. Run a full Bitcoin node. I always ask people, it costs very little money on our platform. Got to participate, man. We got to keep Bitcoin safe. So that's the bare minimum.
Love it. This was a great episode, and we appreciate you coming on. Hopefully we can talk soon.
All right. Take care, guys.
Hey guys, we hope you enjoyed today's episode. Make sure to check out Layer 1 on all the audio and video platforms listed in the description. Thanks for stopping by, and we'll see you next week.